This could trigger the Toronto real estate market crash. Stay tuned to find out exactly what this trigger is. Promise you, it'll be worth it. Good day, Toronto. Welcome to another episode of Prime Properties TV. So glad you could join me here. I'm going to tell you a scary part of most mortgages that I would say most Canadians have no idea what it's going to do, and it could very much trigger a market crash. I'm not even kidding. Like, it actually very much could be, right? Now, this video idea came when talking to a client of mine. Shout out to you, Andrew. You know who you are. When we were kind of just talking about the mortgages we got recently and the amortizations and where they are, right? So, amortization is the length in which you pay off your full mortgage. And we're looking at ours like, oh, we started at 30. And now it's 34 and 39 respectively. We're like, oh, okay. Right? So here's an example of mine, right? Funny, but not funny, right? So obviously there's a big time issue here. So let me explain what's going on, right? So last time when rates were going up, I clarified some differences between what was like a variable fixed payment mortgage versus an adjustable payment variable mortgage for you. And a lot of people didn't know about it, but I just want to put it out there, right? And that video is up here in case you missed it. It will help give you a little bit more of like context as to what I'm talking about right now. So you can check that up and, give you a little bit of homework to watch this. But, if you know your stuff, this will make sense too, right? So your amortization increases like ours when you have a fixed payment variable mortgage. Essentially, all major banks except for Scotia and HSBC have a fixed payment variable. Meaning that when the Bank of Canada's overnight interest rate, right, the one that you see all over the headline, increases, your monthly payment does not increase at all. So this is for all the banks other than HSBC and Scotia. So what happens instead is that the percentage that you pay for interest versus the percentage you pay as principal changes, right? So if before it was like 65-35, it's now like 50-50. So here's a really loose example over here I pulled out to show you the difference on RateHub, to give you an idea of how much principal repayment there is versus how much interest, right? So on your left-hand side, you have your variable mortgage rate before all the crazy rate hikes, right? So that was at like 1.5% variable mortgage. And you can see that on like a $1 million purchase, which means you got an $800,000 mortgage. Your principal repayment is about $21,000 out of $33,000 you pay every single year, which is about like 64.3%, give or take, or so, if I remember correctly, that goes to your principal. So when you increase the rate to where we are roughly right now, 3%, or where we could be in July, depending on whatever your contract rate is, you're now paying $16,000 only to your principal out of your $40,000 yearly payments, or every year instead of 65%, only 41% goes to paying off that principal. And that's a huge difference. And you got to keep in mind that you're now also paying like 18-20% more monthly to service that mortgage. So yeah, it's a big deal. Now, the reason I made this video is to illustrate what will happen if you got a 1.5 fixed payment variable mortgage, which was the left side of the screen, I believe, and your monthly payment doesn't change at all. But as rates go up, obviously there's a problem. So when rates do go up, you're paying less back of that principal amount, since more and more of it is going to pay off the interest portion of the mortgage. So you're going from that 65% principal repayment to the 41%, meaning that your amortization, the period in which you should be fully paying off your mortgage, increases. And this is how we got to the 39-year amortization, 34-year amortization I was showing you earlier on the app. But what you're actually going to do is still pay off that mortgage in 30 years because you signed it in that manner. Now, what happens is something in your fixed payment variable mortgage. Yeah, that's a tongue twister. There's something in there called a trigger rate, which if you read through the documents, you'll see what it is, right? So I've seen trigger rates from 4% all the way to 4.5%. So what a trigger rate is and why this is potentially a trigger that can cause a crash. Yes, pun intended there. But yeah, what happens is that if the trigger rate is reached, your monthly fixed payment that you were paying and enjoying while the interest rates were going up, but your monthly payment wasn't really changing, that resets to force you to go back to an amortization of 30 years. So the kind of loose analogy, I'll take off all the non-English stuff in layman's term. If you imagine someone owes $10 and they promise to pay $1 a year to pay it off in 10 years, that's normal. But if you start paying 50 cents instead for 2 years, you're going to have to spread that 50 cents you owed, the balance of the 2 years, over the last 8 years, right? So effectively, instead of paying $1 a year for the last 8 years because you paid 50 cents, you're now paying $1.10 a year, right? That's kind of essentially what's happening right now when this trigger rate is hit. So anyone with a fixed payment variable mortgage should 100% be aware of this. And it could be a very catastrophic event if many Canadian payments or many Canadians fixed payment variable mortgage hits that trigger rate. Yeah. Now, if you obviously didn't know this, make sure to help us spread the knowledge by liking this video and subscribing to the Prime Properties channel, because we put out awesome content like this to give you an idea of what's happening in the market and some of the nuanced things that most people don't know about that we kind of figure out from doing a lot of transactions and from experience. So we want to share that with you. And we do this so that whenever you think of real estate, whether they're buying, selling, or investing, be like, Zen, those guys, they really knew what they're talking about. I'm going to give them a call and kind of see how I can work with them, right? And if you want to do that, you can book a strategy call with me using the link right here. It's www.chatwithzen.com. Now, let's use that 4% trigger rate as an example, right? And I'm going to warn you, this is going to be a lot of math. And I feel like it's done this way on purpose, as usual with most financial instrument and thingy-mabobs, right, to be confusing. But the 4% trigger rate is the contract rate you have. So say you signed your mortgage, or when you signed your mortgage documents, you were like, oh, I got a mortgage rate of 1.5%. That's your contract rate. So what you'll need to see is that if your contract rate goes up 2.5% to 4% to hit the trigger, just loosely speaking, that's how it works. But in reality, this is based on your contract rates calculation, which is usually, put up on the screen over here, prime plus or minus something, right? So a good rate right now is prime minus 0.8%, which I've seen at a lot of banks, while I've seen others giving out prime minus 0.3%. And here's why this is important for you to understand. And I'll try to explain it to you as easily as possible. Your contract rate is the plus or minus sign on whatever that number is that comes after prime. And what moves when the Bank of Canada changes the interest rate is the prime rate, which is controlled by the bank. So every single time the Bank of Canada, increases or decreases the overnight rates, right, and those are the stuff that's always on the headlines, the banks usually match that increase or decrease against the prime that they have at the bank. So for easy math sakes, right, let's just say you have prime minus 1%. So before the rate hikes, January or early February, right, prime at most banks was 2.45%, except for TD, because TD being TD. So that means 2.45% minus 1% gets you to 1.45%. Hence, you got all your variables at 1.5% in January. Now, when the Bank of Canada increased their rates from 0.25% to 1.5%, right, they've increased that amount, that difference, by 1.25%. So now prime is 2.45 plus 1.25, which makes your prime 3.7 right now. So if your contract mortgage was 3.7% prime minus 1%, that makes your variable mortgage right now 2.7%. Make sense? Not that bad, not that bad. So if not, that's okay. Let me continue. So if your trigger rate is 4% without going through all the painful algebra and grade 9 bed math of you on this video, if prime gets to 5% or effectively another 1.3% interest rate hike from the Bank of Canada, in our example, the trigger rate will be hit for most mortgages, and also the variables will go past the posted rate for the stress test, effectively making everyone qualify at a higher rate and they could borrow less money, because instead of the posted rate, it becomes the contract rate plus 2. Again, explain that in a different video, it's up here. So instead of the 5.25% rate making everyone borrow less, it's the contract rate plus 2, which hence the stress test causes a lot of stress for a lot of people. Now, the combination of the trigger and the less money that you can borrow because of the stress test and fixed rate being over the post rate is a huge problem for the real estate market, because it's a liquidity crisis, right? It's massive, massive. This is why I've been seeing in the past few months that when the variable rate, which is the current saving grace because it's still under the posted rate in the stress test, goes high enough that the market is going to be in for a real heartache, right? Now, the real estate market will experience a massive liquidity crisis, right? Now, this isn't meant to be fear mongering and to freak you out and the world's going to collapse or anything. I'm just putting it out there because some people don't know about it, right? Now, because Bank of Canada still has to increase the rate another 6 times, right? Or 625 basis points to get to that example we're using, and we're probably gonna get one in July. We'll have to see if they do anything in September. We're not quite there yet. So just put that as a silver lining, light at the end of the tunnel kind of thing, right? But if they do it in September and October, like 50 basis points each, then we'll see this event unfold and it is gonna be ridiculous. Now, how your mortgage fares in this situation, I've created a chart over here for you and you can download it in the link. It's in the link in the description below, or you can just freeze frame this video to see. But how this chart works, because I'm sure you're gonna ask, where mine is, right? So let's say your fixed payment variable mortgage is prime minus 0.5, which is over here, and your trigger rate is 4%. You just go along the prime minus 0.5 rate, find out whatever your trigger rate is along that line. I just put anything over 4 is red, anything under green, and you'll see how many times how many basis points has to increase for it to hit that trigger rate and just go straight up, right? So that's kind of why I made this chart for you to easily digest that. Remember, the Bank of Canada has been very hawkish, which means that they're planning to raise interest rates, and they keep saying they're going to do it in like increments of 50 basis points per announcement, which is a lot. And we haven't seen that in like 20 years, but they want to continue to fight inflation. Now, my last thing regarding this topic for you is this, as you'll probably inevitably freak out if you've gotten this far in the video. Sorry, my bad. If your trigger rate hits, I've spoken to all my brokers, do not fear. You will not need to requalify under this trigger rate and under what is potentially a higher stress test. What happens is that your amortization payments get calculated and your monthly payments will increase, like they will go up, so that your principal payments is going to hit that 30-year amortization schedule that you signed for once again. Now, this is the scary part. The monthly payment increase will be shocking. Yeah. I haven't done the math for that yet, but I bet it's in the thousands of dollars for what is the conventional 80% loan to value mortgage at the market price of like $1.2, $1.3 million. Yeah, it's rough. The question becomes, will Bank of Canada hike rates there, right? Like my thinking right now, and still has kind of been this whole time since like March, is that they don't want to, but I think they have to fight inflation, which may, accidentally force them to break something in the market. And I've been saying this in the past, and this accidentally breaking something will be a policy error on their part that triggers a lot of these mortgage trigger rates and the variable to go like past the posted stress test. And it's really going to cost a lot of stress in the real estate market. And the real estate market is so much of the Canadian GDP that they may have the reverse course. Now, that's going to hurt a lot of families who can't afford another $1,000 in monthly payment, especially when inflation is so high, gas is so high, food is so high, which ultimately reduces consumption drastically, which forces some potential liquidations of properties and selling stuff in a bad market, which means they lose money, which means GDP goes down, and it gives the good old recession a boost in the totally wrong way. Now, I don't want to see this happen, but I think there is a chance that they're going to overdo it on the rates to prove a point just so that they can regain some lost credibility. And this could be an ego thing. I don't know, right? But when they realize they break something and the error, they'll probably reverse course. They can't really engineer a soft landing, which a lot of people are using the term now. I don't think it's just possible with so much debt in the system. It's either broken or propped up, right? So the only time will tell is how much pain they're going to inflict before they reverse course. Now, if you're looking to work with our real estate team to buy and sell, when the time is right, because again, depending on the nuances of where you are, obviously it may not be the right time. But whenever it is right time and you want to work with realtors like us who are very analytical and we analyze a lot of factors such as this one to give you an assessment of when it's best to be opportunistic, you can book a strategy call with me using the link right here. It's www.chatwithzen.com. This way I can tell you what to expect, what we're thinking in terms of timing, and what to do to get ready for these opportunities if and when they come, right? So again, it's on the link right here. It's www.chatwithzen.com, and hopefully this was somewhat helpful for you, not to freak you out or anything, but just to give an idea of, some systemic issues we have with the rates going up so much. And I'm just trying to share my knowledge with you so it doesn't get, you get caught off guard, right? So anyways, hope this was helpful. Until next time, your move, your future. See ya. Now that you're done watching this one, how about this one? Oh, you know what? This one's good too. Ooh, this one's really good. You know what?